to this problem when we have time. Describe bonds payable as another type of long-term liability. So far we talked about long-term notes payable. We talked about mortgage payable. It's backed up by assets. If the borrower doesn't pay back the money, then the creditor has the right to legally have the title of the assets. Bonds payable is another type of long-term liability. It's sort of like groups of long-term notes, except that it's more structured in a way. Usually bond certificates are issued by companies and typically on a specific value for each bond certificate. Usually it's by $1,000 by a unit. I mean, each bond certificate may state $1,000 and their interest rate that they want to offer to creditor. Then they issue it out. Whether or not they can get that $1,000 depends on the market's status at that moment. Okay, so later on we'll go into, in case that the company is offering an interest rate that is different from what the market is expecting, how will we deal with those issues, the three different types. Okay, sometimes the interest rate matches, meaning if the company wants to borrow money, they're offering creditor a certain portion of interest rate, let's say 6%. If the market also has a 6% anticipation, if it matches, then it's great. They want to issue $1,000 and they can borrow $1,000 from the market. In case that interest rate doesn't match, sometimes company doesn't have enough fund, they're only able to give out 5% of interest rate. But if the creditor, the market is expecting a higher interest rate, then basically your company's bond is not as attractive. So you may not be able to entirely borrow the $1,000. Perhaps you'll only be able to borrow $980 or $970. If we flip the case, sometimes if your company is doing pretty well, you're able to offer an interest rate that's even higher than what the market is expecting, then your bond certificate is more attractive to the market. You'll be able to borrow more money than what's stated on the bond certificate. So this is another way to increase the fund for company to operate their activities, to have additional fund other than what they raise from stock. They can also raise money from issuing bond. Okay, but the difference is that if you issue bond, whoever that holds it is not a stockholder, but a creditor. Okay, because they basically borrow money to your company, they need to get it back from you later, and you also will be paying interest. If it's stock, it's another issue. Okay, stock will be covering this in chapter 12 and 13, but try not to confuse the two. Okay, this is a way to borrow money. Stock is a way to raise capital, and you don't have to pay back or pay interest to it. But bond is just like a regular type of liability, except that it's more structured. Okay, $1,000 a unit bond certificate will be determining what is the actual amount that the company is actually able to receive at the time they issue it. May not necessarily be $1,000. Depends on how the market's interest rate is compared to your company's interest rate that's willing to offer to creditor. Okay, so basically the purpose, again, is for large companies to require large amount of money from the public to finance operations, borrow money from the public. They issue bond certificate. This is a source document, evidence of this loan. Loan means the debts that you raise from public, the money that you borrow. So on the bond certificate would state definitely the amount, the maturity date, when is the bond due. So just like short-term notes, long-term notes, it has a due date, and also interest rate that your company is offering to creditor. Okay, bondholders receive interest, and another difference between this and short-term and long-term notes is that bondholders, creditors, usually receive interest semi-annually. Half a year later after they borrow money, they receive a portion of interest. Half a year later, they receive a portion of interest. So this is kind of the fixed rule for bond. Okay, you borrow money to the company, a company raises money from you, you get the interest rate half a year later, every half a year, semi-annually. Okay, now the principal amount is usually not paid like long-term notes on an installment basis, not paid incrementally little by little every single year. It's usually paid back the very last year. Okay, so interest rate is breakdown twice a year for sure. Principal amount usually for most of the cases is paid off at the end of the year. For most of the problems you see in this chapter, it will be paid off at the end of the year. Okay, meaning that we don't break it down into different years, little by little. Company will be paying off this to creditors altogether, but interest will be paying little by little. Now, another terminology difference is that maturity value. We've learned this in short-term notes and long-term notes. So what does it mean, maturity value? Principal amount plus interest, exactly. Now, in the bond section here, maturity value always refers to the original face value of the bond. Okay, under bond, the section here, maturity value equals face value equals par value. You may see these terms interchangeable in the book. Maturity value of the bond, par value of the bond, face value of the bond. That's everything you see on the face of the bond. Okay, later when we go into, yes?
Face value includes the interest.
Doesn't include the interest. Okay, so maturity value for bonds specifically does not incorporate interest. For short-term notes, long-term notes, maturity value is principal plus interest together, right, when it's due. That's how you calculate it in Chapter 10. Or up to now, for long-term notes, it's at the same time. But for bond, whenever we say when bond matures, the maturity value of bond is always not including interest, just the face value of it, $100,000. So it's like the idea of your original principal amount. Okay, so later when we talk about an example, if a company raises bond $1,000, regardless of what's the dollar amount they actually receive, maturity value is $1,000. If a company raises bond, issues bond $100,000, the face value is $100,000 you see in the problem, or it tells you the par value is $100,000, maturity value is $100,000. Okay, so this maturity value would always be the money that a company pays back to a creditor. Sometimes, even if they don't actually borrow, they didn't actually borrow $100,000, they later still have to pay the maturity value, the face value, the par value. Okay, so these three terms are interchangeable. You just have to keep it in your mind.